This video is going to be a great one because I'm answering a couple burning questions from you all. These 3 questions have been asked many times, so I'm excited to get to it. I'll take about 3 minutes or so per question and not go super deep because this is going to be more of an office hours type video. The 3 topics will be paying off debt versus investing, the Roth IRA and why I know taxes will be worse in 10 years, and when and why we should sell an underperforming stock or ETF. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. This first question is one that I'm sure we're all going to be faced with at some point, so I'm going to give you 3 options and all of them are solid. Say I owe $35,000 on my truck at 3.4% APR. Would paying that off make sense assuming I have the cash, or invest it hoping to achieve a better return while making the minimum payments? The classic debate comes down to, should I just pay this whole thing off so that I don't have to pay any interest on the loan? Or is the compound interest that we could get by investing that full amount right now more than what we would be getting if we were paying down that interest rate? But there's another option that I actually recommend over both of these. But first, if you go with option number 1 and you pay off the truck fully right now, you save hundreds of dollars worth of interest over the next 5 years, and more importantly, you've paid off that debt, so now you have peace of mind and you don't have debt in that area anymore. Option number 2 would be that you take that $35,000 and instead of paying it all off, you put it into the stock market. If you put that $35,000 in an index fund like the S&P 500 that's appreciated at 10% on average, you could have over $56,000 or could have made $21,000 in that period of time. With this option though, you would still be living with that debt, and every single month you'd have to be paying about $600 towards that loan, so that would be taken out of your paycheck. Purely numbers wise, option number 2 is strongest, but it's not just about the numbers. The stress of having that loan on your back may be a little too much for you. And also, the stock market could go down in that period of time, so you could actually lose some money. The third option is the option that I recommend over both, especially now in late 2023. Interest rates in a high-yield savings account are amazing. Most good ones are hovering around 5%. Throw that $35,000 in there, earn 5%, and then just pay the loan off normally, not any faster. With a loan interest of 3.4%, and then you're getting 5% on your money sitting in the savings account, you're actually positive 1.6%, and your stress will be super low knowing you have all the money sitting there to pay it off whenever you want. But more importantly with this option is that you do have the cash, so in the case of an unfortunate emergency or something where you need a bulk amount of cash, you won't have to go into debt or use a credit card or anything like that to be able to pull that money out. You'll have that money sitting there and you'll be thankful that you did. There's really no con to this option that I can see, so this is the way that I would recommend to do it, and this is the way that I pay things off myself. This next question came in on one of my Roth IRA videos where I was talking about my thoughts on why taxes are going to be higher in 10 years, but for sure in 20 years. Many finance professionals say that the Roth IRA is the ultimate investing account, but they don't necessarily explain exactly why. This is one that I highly recommend that you should be maxing out every single year if you can. And the biggest reason why anyone should take the benefits of investing within a Roth IRA is because of the tax benefits you're gonna get down the road. Here in the United States, sometimes we forget that our country is so young, and so we're just at the beginning of the taxation cycle. Whereas if we look at countries that have been around for a long period of time, like China or England or any of these, we see that their taxes have raised, especially in times of need for the country. As far as the history of taxes in England, income tax was implemented in Great Britain by William Pitt the Younger to pay for weapons and equipment in preparation for the Napoleonic Wars. In the First World War, during 1914 to 1918, the war was financed by borrowing large sums at home and abroad. The main increase in revenue came from the income tax, which in 1915 went up to 17.5%. The income tax rate grew to 25% in 1916 and 30% in 1918. The highest rate of income tax peaked in the Second World War at 99.25%. Wow! It was then slightly reduced and was around 90% through the 1950s and 60s. Still wow. Now it's closer to 45% because they saw that people just can't live like that and they actually need money to live daily. But here in the United States, we're starting to see that trend, that the government is starting to turn that lever and push as far as we're going to be able to let them go and slightly increase taxes every couple years in order to pay off some of this crazy debt. We have wars to finance, but even more than that is all the money printing that went on during COVID. President Biden has already been proposing new and higher taxes overall because something does need to be done. The United States national debt just recently hit $33 trillion, which is a number that most cannot actually comprehend. If you go back 1 billion seconds, you'd be in 1992. If you go back 1 trillion seconds, you'd be in 30,000 BC. And we have $33 trillion worth of debt. It's going to take a lot more than the government just making smarter spending habits and by selling a couple assets. They're going to call on the 332 million people that we have living in the United States and up their taxes by 5, 10, 15% down the road in order to start paying some of this down. So this is why the Roth IRA is so important, because you're paying your taxes right now where the taxes are still kind of high but somewhat favorable compared to where I think they're going to be. Once you've paid the taxes on that money, it can now grow totally tax-free and compound interest for 10 years, 20 years, 30 years. All of that money is totally tax-free when you want to pull it out if you've been investing in the Roth IRA. So if taxes are at 40% down the road, you don't get taxed at all. To put this in perspective, if you have $1 million sitting in your Roth IRA and you're 65 years old and you want to pull $60,000 out because that's how much you need to live that year, you can pull that $60,000 out, totally tax-free, and you still have $940,000 sitting there and can still accrue interest. If your money's just in an IRA or a 401k and you have $1 million and you need to pull out $60,000 because that's how much you need to live, if taxes are up to say 40% like I was saying, you'd have to actually pull out $90,000 in order to live off of just $60,000 because you'd have to pay that much in taxes. So now you'll only have $910,000 sitting there, which really, if you think about it, is only about another 9 years worth of safety. So in retirement, that's kind of scary. That's why in this video, I go over the steps that everyone should accomplish in their investing and what order one should follow, specifically talking about the Roth IRA. I'll link to it down below for you to watch later, but definitely check that one out. And this last question comes from Tina, and she asks, when should we sell or trade your current holdings in order to invest in preferred holdings? When? How? Should we? Great question, and let's start with why should somebody consider selling off a holding that they have? Obviously, the stock or ETF is severely underperforming other stocks and ETFs for an extended period of time. Not for a week, not for a month. All stocks are going to drop at some point. They're going to drop 2%, 5%, even 10%. This doesn't necessarily mean that they're a bad stock and that you should sell. That's actually a great time to look at certain stocks to maybe make them a buy. But if a stock is actually dying, it is definitely time to cycle that out. But it's very, very tough to actually understand when a stock is just down versus actually dying, and it's probably time to lay that thing to rest. One thing I keep in mind is watching not just the company itself, but other companies within the same industry. If Lowe's stock is down big, but then I look at Home Depot and their stock's down pretty big, and most of the other home improvement type stocks are down big, then that lets me know it's not just a company problem, it's actually an industry problem, and it's something a little bit more macro. And when that's the case, that's a bigger consumer behavior issue, and that's probably something happening in the economy. And so for something like that, I definitely wouldn't be looking to sell that stock yet. If the other companies in the industry are doing well, but then the stock that you own is down like 40%, that might start to mean that your company is starting to lose a bunch of market share and the other ones are eating that up, and that shows that your company is probably dying while the other ones are getting stronger. So when should we sell that underperforming stock? And my answer to that is as soon as possible. As soon as you've made the decision that this stock is no longer good for you, you have to rip it off like a band-aid and just make it happen. Just like you can't time the market in buying stocks, it's very hard to time the market in selling stocks. You're probably not going to sell at the most optimal price, and the longer you hold, the thing's probably going to die further. So when I've made a decision that this stock is no longer one for me, I sell out of it, cut my losses if that's the case, and move on to something that I know is tried and true and that is gonna be a good solid investment long term. How should you sell it? The thing that you have to keep in mind is taxes, specifically if this is in a brokerage account. If this is in a Roth IRA or even 401k, you're not being taxed on the sell right then and there, so that matters less. But if you're being taxed on every time that you sell a stock in a regular brokerage account, you just have to keep in mind, has this thing made any money overall since you bought it? Because if so, you're gonna be taxed on that gain, and so that's just something to keep in mind. But as long as you understand that, just like the step before, pull the trigger and get it done. Now the last part of that question is, Should we do this? That's a very tough question to answer, and unfortunately, the answer is it depends, and much research is needed. Picking individual stocks is incredibly difficult, and it's much tougher than most would make it seem. I suggest most people just invest in an ETF that tracks a very solid index, like the S&P 500, which is definitely my favorite. And in this video, I describe my price prediction for the S&P 500 by 2030. Or check out this playlist of more office hours videos that go over solid questions from you that'll lead to healthy investing and financial freedom.